Hi, this is Phil Tubner, owner of Breakout Private Wealth. In case we have not met, for this week's Breakout report, I wanted to do a short video on something that's very important and something that we've been working with our clients diligently on. Just so you know, it's Friday afternoon and I'm on my way to my son's baseball game in a bit. Therefore, the rather casual attire. Um, this slide comes from JP Morgan Asset Management's Guide to the Markets. It's a great publication. They really do a nice job of bringing forward some of the important topics that we discuss. And for this week, it's going to be about how critical it is to segment your portfolios based on when you need or expect to need those assets. They define it here, and I'm pretty good with their definitions of short, medium, and long term. Reality is, any money that you think that you will need inside about 5 years should not be invested in the stock market. Short-term returns are subject to volatility, are very random, can be very emotional, as we've seen in the past, and that is not a place for what we would call short-term money. That's where financial anxiety and watching your portfolio every day, that's where that comes into play. Most people intuitively understand that, although I've seen some people that don't. But I often see this middle bucket, if you will, not funded or not paying attention to. The reality is, in 10 years, capital markets, stock market will, sorry about that, will perform for the most part. But inside of those 10 years, like I said, we really do not know what's going to happen. So having a lower volatility bucket, easy example is, let's say you wish to buy a home, second home, in about 5 years. In 5 years, in a long-term investment portfolio, we may not be quite sure the value of that, but with some volatility control and a different type of strategy, we can help you achieve that inside those periods of 10 years. I think that's very important to understand. And then, of course, we have long term, which is really where returns can grow and compound, and that's always a very good place to be. You can see here in their chart how actually over time investing becomes, I guess, quote unquote, less risky. Meaning here, over time, you can see that pretty much anything can happen. The longer you hold a properly constructed portfolio, the better odds and probabilities become that you will have long-term success, if you will. Very interesting, I think, intuitive for some people, but even for me that's been doing this quite a long time, when I see it in front of me, it reinforces how important it is that we do and why we do what we do. So something to think about here for this week's breakout report. Let me know if you like the new video format. I just thought that this was something very important and wanted to share it with you. Have a great week.